Welcome to Turning Hard Times into Good Times with your host, Jay Taylor. This hour will help investors fix issues and achieve personal gain. Now, here's your host, Jay Taylor.
Welcome to a special edition of Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Ron Perry. He's the treasurer of Metanor. He's on the board of directors as well. He is here to tell us why he thinks Metanor Resources is a turnaround story and why you should pay some attention to this company. Metanor trades in Toronto under the symbol MTO. You can buy it down here in the United States, as I have, under the symbol MEAOF. And the company has about 350 million shares outstanding. It's trading at just 4.5 cents Canadian. That's about 3 cents US. It's giving it a market cap of around 16 million Canadian. And I can tell you, and as one who's followed this company for a number of years, it has a number of very outstanding assets. Of course, this is something that we see constantly in the gold sector these days. A lot of companies with good assets are trading way below what I think they should be worth. But that's the market. We've been in a 5-year bear market, and so companies have really taken it on the chin. And Metanor, I think, has been, I think, devalued further than many of the others that I've followed. So it's really good to have you with me again, Ron. Thanks for joining me today.
Well, thank you so much for having me, Joe.
You know, Ron, I'm looking at a stock chart of Metanor. It goes back 5 years, which is just about the length of time that we've had this bear market in gold. And your stock briefly hit 70 cents in 2011, but now it's down around 4 or 5 cents, as we just noted. We should always be looking to buy low and sell high, but clearly, most people operate in the opposite way. When stocks start to rise, they want to jump on the bandwagon, and when they're sitting down at these levels, they rather not pay much attention to it. But if perhaps you can give us some idea of why, just because something is cheap doesn't mean you should buy it. So there needs to be asset value there. I know there's asset value there, Ron, because I've been following your story for a number of years. But help our listeners understand why they should pay attention right now to Metanor at 4.5 cents. Let's talk about some of the assets that you have. For example, you have a mill, and it costs a lot of money to build a new mill these days, but you've got a mill. Talk to us about the mill and its capacity.
Okay, the present Bachelor mill is we'll call it the template is at 800 tons per day hard ore. When we were operating the Barrie open pit, the capacity is 1,200 tons per day softer ore. So while we're using Bachelor ore, we can run up to about 800 tons per day, and then if you account for some shutdowns for maintenance, it takes the 800 tons a day down to around 713 tons per day for the entire month. Mm-hmm. That's the capacity of the mill.
All right, and you have indicated, though, that you could actually increase that substantially with a couple of $1 million of CapEx, I think.
That's correct. Our president, Bachelor Mine, said that for about $2-3 million, there's not a lot of just changing a few of the ball mills into maybe one a SAG mill. We have very good experience in construction. That's one thing that Metanor has always been good at, is building things on time and under budget, and I could cite a whole bunch of examples, but that's one of our expertise.
Yeah, indeed. Certainly, CapEx has been kept low. Your most advanced, actually, your producing mine is the Bachelor Mine. And if I understood what you were saying correctly, if you process Bachelor Mine, the ore is maybe harder, the rock is harder from which that hosts the gold, so the capacity isn't as great as if you had softer ore from the Barrie, which is another deposit that you have produced from. But talk to us a little bit about the Bachelor Mine, and you're in production there now, Ron. How much are you producing, and what is it costing you to produce from the Bachelor Mine now?
Well, let's go back to a little bit of the history. We can do around 50,000 ounces. We could probably do more, but 50,000 is a good sweet spot. It gives us time to develop other sections to keep the mine life, because we don't have in Abitibi, You don't have a 10-year mine life. The old, like the Richmond Beaufort mine had a 1-year mine life always in front of it, and
Sure.
it's been operating for 25 years. That's typical of Abitibi. We have 3-4 years ahead of us. So at 50,000 ounces maximum is a good number to balance mine life and the underworkings. Remember, we're not Agnico Eagle. We don't have multiple mines, 10 workstations underground. So what happened to us in the last quarter of the physical 2014, and hence here's where the opportunity lies, is that we did drop off the map. We did have a dilution issue. So we went from 12,000 ounces of production all the way down to 8. So that's why our stock is where it is. That's where it's been basing. It's been accumulating now at 4 or 5 cents. But it is, as you said at the beginning, it is a turnaround. The sum of the parts are definitely greater than the whole, and I know we'll get into each of the parts. And that's why I like what you're doing with this interview, Jay, is we're going line by line.
Yeah.
There is a lot of value here. So we are ready to leverage the production as the grade improves, which we're doing a great job. We've done a lot of cost controls. Our cash cost at 9,860 ounces for the quarter was $850 US, all in 959. But imagine if we were back up to normal. We're not there yet, but we're on our way. But imagine if we were at 11 to 12,000 ounces. Our cash costs would go down to probably 700, close to 700, and all in would go down to under 8. Mm-hmm. So we're approaching pretty good numbers on the world stage as long as we continue to execute. So we're slowly bringing the production back up. And obviously we're looking forward to our year end is June 30th, so we're looking forward to the next year and getting it back up to closer to the 50,000 ounces.
All right, Ron, and you had some production in the past from the Barry mine, an open pit mine. I guess it was sort of marginally profitable then because of the hauling distance. You were hauling the Barry ore down to the Bachelor mill. Talk to us about the Barry and the prospects for the Barry now, because that seemed to have potential to be a multi-million ounce deposit, near surface deposit.
Yes, and it still does. Unfortunately, that's when our stock was up to 70 cents. That's when we were operating Barry, but our 43-101 had a double-edged sword. The grade, unfortunately, went from 3 grams to 1.3, 1.4. But the ounces went up from when we bought it at 40,000 ounces to almost 800,000 ounces, all categories. So that was, pun intended, the silver lining was the resource, the 43-101 came out with a lot more ounces, but the bad news was the grade, so that's why we stopped producing. But it is open in all directions. It is a great asset, and we are re-looking at it with consultants, and that's why we're going to do a drilling campaign in the pit, a limited drilling campaign, because there might be a way to high grade it back to 2 grams plus. Now, here's the balance sheet. You're looking at Bachelor operating when we have a gold stream on it. So 80% is ours, and 20% we sell to Sandstorm, who has prepaid some gold. They gave us $20 million. It's not a loan; it's a stream. So we amortize that. So we get 500 cash, but we do have revenue that was paid in advance to do it. So you look at that like I'm paid by Bachelor. So now we have to do what we call a marginal variable cost analysis. Gold is at $1,200 US. How much does it cost for a couple of trucks, a loader, dynamite people, opening up the camp, and operating Barry? If there's profit at the end of that, and it's more profitable than operating an extra 10,000 ounces out of Bachelor, then we have the option, and we can commingle ore. And as I said, for a slight investment, we could increase the capacity of the mill. And as stated in our last press release, Hydro-Quebec is planning a substation for this fall. And once that's in place, then we could increase the capacity of the mill, because then we'll have the power available. That was one of the limiting factors.
Yeah, one of the things that I found really interesting in the past when I followed your story, Ron, was the notion that you might be able to put together a concentration plant for a relatively low capital expenditure there at Barrie. And because 1.3 grams per ton is not an unreasonable grade for a profitable open pit mine these days. But when you have to haul that ore of that grade a long ways, then it loses its economic viability. But the notion that you might build a concentration plant sometime there at the Barrie and then haul a concentrate down to the mill always seemed to make an awful lot of sense to me. Is that something that your management team is still looking at?
Oh, we're still looking at it. Obviously, we don't want to spend that money right now because our share is sub 5 cents, and we're not looking to raise money at these levels. But it is an option. But what we're looking at now is just the marginal. So in other words, a limited production, maybe up to 10,000 ounces per year. But we're analyzing it. We haven't come up with a conclusion. So if there is a marginal profit there with virtually not much investment, then it may be worth it to start bringing some Barrie ore to the mill. As that progresses, and as we, if there's some of the profit, we'd love to reinvest it into drill holes. And as that resource gets to almost 1 million plus ounces, then you start to be able to do a PEA and look at things. But that's the future. But you're right. With the concentrator, if you did 20 to 1, you're carrying 25 grams, and at $17, $18 trucking charge, it's 6 trucks, 7 trucks per load.
Right, you could really boost your
trucking significantly low, and it becomes even marginally more profitable. So baby steps first.
Yeah.
We have, as we said in our press release on June 1st, that we have $4.4 million in cash. We're cash flowing. We depreciate the company $3 million a quarter on average. That's a steep depreciation because of our mine life. And
sure.
We're stuck with that, but at least we're cash flow positive, cash in the bank. Some of the parts are great in the hole, and the Bachelor Mine is open at depth, but we're going towards U-Friend. Why? We don't want to be in a position where we have to sink shafts. On U-Friend, there's levels 6 and 8 that were already there when U-Friend was a separate asset. It was owned by Ore Resources and Caminco, and we bought it 100%. So it's very promising, and we're drilling, and we should have more drill results in that area.
Okay, Ron, the U-Fran then is part of the Bachelor Mine, right?
We call it all Bachelor.
Okay, now is the U-Fran also subject to 20% in the streaming agreement with Sandstorm?
Yes, it is. The present streaming agreement calls for anything within a radius of 1.5 kilometers is automatically included. Outside of 1.5 kilometers is what they call a new mine right. So say we, one of the new discoveries was close to the road, so that was outside the 1.5. Say we invested and we brought it to a point that we think that we could start producing. Then Sandstorm has the option to pay 20% of that work and then include it. Or they have the right to back out. In other words, no, we don't want to pay for the 20%. Say we spend $2 million or whatever. So they'd have to write us a check. If they did write the check, then it becomes eligible. And if they didn't write the check, then it becomes 100% ours on the outside of the 1.5 kilometers.
Okay. All right. Well, let's just talk quickly about a couple of other properties you have as well. There's something called the Nelligan. There's a Dubuisson. Yep. There's another one, and I don't know if I can pronounce it. Wanapiti. Yeah. So talk to us about those. Are I guess further down the road. Any work done on those? Any prospects for near?
Not recently. Nelligan is a property adjacent to U-Friend. Mm-hmm. We own it 70%, and the other 30% is Murgwar. Mm-hmm. And we did do one wildcat hole and hit 28 grams over 4.5 meters. So it's very promising. It's on the same geology as Bachelor U-Friend. So there's very good potential, and we own that 70%. Dubuisson is the original property that when Metanor went public many, many years ago as an exploration play, it's in downtown Val-d'Or, close to Agnico Eagle's Goldex project. So it's actually in center of town. We have a sign on one of the roundabouts. It's right there. It's got about 500,000 ounces, a lot of inferred, a lot of potential, but right now we're focused on the Bachelor and Barrie.
Is that an underground target, Ron? Or
it could be an underground target. There was there was a shaft there, but it requires some work, but it's got some promising geology. As well as Wanapati is a small property in Ontario near Sudbury, near Nickel Rim South, with a lot of geology. It's smack in the middle, close to you, and the Nickel Rim head frame is. I haven't been to the property because it's small, but it's something in inventory, and it's a good potential for the future.
Yeah, well, obviously, as you said, baby steps now. You got to get you're getting your balance sheet back in order. You did have at least a small accounting profit in the most recent quarter, and larger cash flow, positive cash flow from operations, which is encouraging, of course. And one of the things, Ron, that I think is very encouraging to me is the recent news that Osisko Royalties has stepped into the area surrounding the Barry deposit. And you noted in a press release that Osisko's management, that you and the other members of management are very encouraged by this Osisko activity when they stepped in and bought the Oban mining company. Can you talk a little bit about why that might be an encouraging thing and why people should pay some attention to what Osisko is doing up there in your backyard?
Well, Osisko are very smart people and very good management, and it's always a question for us juniors. It's always, did we pick a good area, and how do we get some stars on our thing? Because we're not Sean Rosen and Ned Goodman, but the fact that they came into the urban Barrie Township and took over Eagle Hill, which is kitty corner to it's in the northeastern quadrant of our property, the Barrie, and they've also intended, the transaction hasn't closed, it'll close in August, but they intended also to invest 20% into Bonterra, the old eastern extension, which is to the east of Barrie. So, and they've staked other properties to the east of where they are. So they're coming into the urban Barrie Township, and we are the Barrie of the urban Barrie Township. That's the best way to say it. So the Barrie Lake is on our property. The Barrie Mine is ours. So we're there. So if people are investing there, then people should look at, that's why we have been studying Barrie for the last year, looking at ways to perhaps bring it into production, look at ways of eventually financing more exploration. But it's, they've definitely put it back on the map because of their intention of consolidating with Eagle Hill in that area and through the Oban. So it's always a pleasure to see a large, recognized, successful management team say, hey, this is a good area. Well, we're already there. And we have 800,000 ounces, all categories, and it hasn't been drilled that much. The pit is less than a kilometer long. It's open at depth. There's a lot of potential there, and SGS Geostat said that it could be a multi-million ounce deposit. Maybe it's not 10 million like Osisko, but they put Osisko, they put the Joanna project, and that was in Orizon, and they also put Detour as compared. But they stress that you have to drill. So
sure,
that's why it's back on the map. And what it does is that, as I said at the beginning, and you said this is a turnaround, but it also proves that the sum of the parts is greater than the whole. Our market cap's at $16 million, and the transaction that Oban Osisko just did to Eagle Hill valued their 1.6 million ounces at $28.7 million. That's in their presentation. So we're half that, and we're lower grade, but to counter the lower grade, we're a permitted mine. It was in production before, and we have access to a mill right away. The mill is ours. We own it 100%. So that's why we're very encouraged by this activity in the area, and it's brought a lot of attention to us. And I think there's going to be some good appreciation as we tell the story, that people will say, hey, they're right near Oban and Osisko.
Yeah, I would certainly think so. And of course, it's at times like these at the bottom of markets when nobody's paying attention that profits are made by the smart investors and the likes of the Rick Rules of this world, the Eric Sprotts, the Osiskos, Sean Rosen, and those kind of people are licking their chops right now at undervalued assets. And I think that probably it would pay most of our listeners to pay attention to what some of those smart investors are doing as they're starting to acquire undervalued gold mining assets. And I would think, with a $16 million market cap, I mean, Ron, if you were to build that mill right now, it would cost far more than that.
Oh, far more than that. I mean,
yeah.
Obviously, infrastructure on our 5 properties, if you just found Bachelor, moose pasture, you found Barry, moose pasture, and built the roads and get the hydro and get all that, you're talking 150 million plus where we are. But, nobody cares about that. But the point is that there's value. Our book value is 15 cents per share, as I said earlier. So, trading at 4.5 cents is ridiculous, but we have to tell the story, and there's a lot of miners that are going out of business. The sand gold was once a darling of the street, and it's
it's
going
really
to get refinanced and eventually come back out, but it's going to go through bankruptcy.
Yeah.
We're still alive and kicking. We're survivors. We're builders. What we do well is build. And as long as we stay, we have $4.4 million in the bank, positive working capital, cash flowing from operations, and that will improve. Leverage to the price of gold, leverage to grade, but also protected by the U.S. dollar. I mean, we do sell gold in U.S. and pay everybody in Canadian.
Sure.
So that's been helping us a lot.
Yeah. Well, indeed, and one more thing I would just add for the benefit of our listeners in case they've overlooked it is the fact that you are operating in one of the most mine-friendly jurisdictions in the world. Quebec frequently gets the top 1, 2, 3, or 4 ratings from the Fraser Institute. So that's another reason, I think, in a world that's increasingly troubled, why people might want to take a look at your story, because it is domiciled in one of the most mine-friendly and politically safe jurisdictions for mining in the world. So, anything else you'd like to add, Ron, before we conclude our discussion for today?
No, I think just in summary, the balance sheet has improved substantially since we now have a convertible debenture only due in August 2017, and it's been reduced to $9 million. The loan to Investissement Quebec was $7 million, is going to be fully repaid in August. So we've done a lot to improve. Our cash costs are reasonable where they are, but as grade improves and production increases, cash costs will continue to go down. So, and as I said, we're leveraged to the price of gold. I think gold has to eventually one day go up, so we'll be in a good position. And the sum of the parts is definitely greater than the whole, that's for sure.
All right. Well, thank you very much, Ron. I think you've really told the story very well, and it's certainly one that I want to keep a close eye on and probably put on my watch list in my newsletter again. So I want to thank you very much for spending the time to, and all the best to you for a turnaround, Ron, and to Jesse and all the rest of the men up there that I've learned to know over the years. So we'll look forward to talking to you again and keeping up with the story, Ron.
Thanks again.